Forming an LLC protects your personal assets from liabilities arising in business. This limited liability coverage is also known as the corporate veil. However, simple mistakes can pierce this veil, putting your personal assets at risk. Watch this video to learn about the corporate veil, how to protect it, and what it does not cover. LLCs are a business structure designed to protect their owners from personal liabilities for the business's debts, hence the name limited liability company. This protection is often referred to as the corporate veil, and it creates a legal distinction between a company and its owners. However, there are situations when a court can pierce this veil, and the owners and members can be held legally responsible for debts and lawsuits against the company. An unpaid creditor, for example, can sue the owners to collect a debt incurred by the business. If the court can prove that the corporate veil has been pierced by commingling assets, improper filings, or fraudulent activity, the limited liability protection offered by an LLC structure is rendered invalid. In that case, the creditors would be able to collect their debts directly from the personal assets of the company owners and members. To preserve the corporate veil, there are several guidelines to follow. 1. Sign correctly. It might not seem like a big deal, but how you sign business documents needs to reflect that the company is separate from you as a person. Any business dealings and contracts should be carried out in the name of the company, with the individual signer clarifying that they are signing on behalf of the company as an authorized and titled member. This will demonstrate on an ongoing basis that you are not individually responsible for the company's debts. 2. Don't commingle finances. Failure to establish clear separation between personal and business finances is a common mistake, particularly among underfunded companies. Your LLC should have its own bank account and credit card, and engage in its own transactions separate from the owners. Owners should not utilize the company's money for their own individual purposes, for example, paying home cable bills, without adequately documenting the transaction as a loan or a draw. If the company needs additional funds and the owner wishes to contribute, this should be documented as a capital contribution with appropriate documentation created at the time of the transaction. Always document business expenses. There are many accounting and bookkeeping solutions available. 3. Follow an operating agreement. An operating agreement is an internal document that outlines the ownership and member roles of the company and gives your LLC legal credibility. This is particularly important for single-member LLCs, as you will need to provide evidence to the court that you have not compromised the distinction between yourself and the entity known as your company. For this reason, it is also important to document major decisions and resolutions with a formal paper trail to demonstrate that you are treating the company's affairs as separate from your own. 4. Keep your LLC up to date. In some states, failure to file an annual report with the state of formation can result in automatic dissolution of your LLC. If your LLC is dissolved by the state, the owners of the business no longer have limited liability protection. What the corporate veil does not cover. Even if you perfectly maintain the separate identity of the company, there are still some situations where the owners may become liable. These include 1. Personal guarantee obligations. If an owner signs a personal guarantee of the company's obligations, when signing a commercial lease or loan agreement, for example, it is a voluntary waiver of the corporate veil. 2. Liability for personal acts or carelessness. There are situations where individual members, although acting on behalf of the company, have personal liability for their actions. If personal recklessness or carelessness causes an injury, for example, the individual as well as the company may be liable for the resulting harm. 3. Liability for taxes. Members of limited liability companies are personally liable for their own taxes resulting from company operations. They may also be personally liable for certain taxes of the company. To protect yourself, it is critical to properly account for company transactions and remit all taxes due to the various taxing authorities by the deadlines. To recap, the corporate veil ensures the limited liability of an LLC. To preserve it, business owners must sign documents correctly, keep personal and business finances separate, draft and follow an operating agreement, avoid fraudulent activities, and keep up to date with annual filings. A corporate veil does not cover personal guarantee obligations, personal acts or carelessness, or certain tax liabilities. To learn about the corporate veil, LLC formation and maintenance, and to research other small business resources, follow the links below and visit us at howtostartanllc.com.